All right, let's jump right back into this explainer and build immediately on what we learned in part one. We've been looking at the grand machinery of stock selection, and today we're snapping a absolutely crucial new piece into place.
Last time, we put value and growth in the boxing ring. We established that value investing is your armor during a bear market, while growth, well, that's your high-octane engine for trending bullish markets. You know exactly how you want to invest based on the market's direction. But here's the thing. Now we need to layer in the second decision that every single stock pick requires. And it is a big one. It's not just about value or growth. It's about determining the exact correct size of the company based on where we currently sit in the economic cycle. Simply put, are we looking for a nimble speedboat, or do we need a massive cruise ship? Let's look at asset class segmentation. Think of these as the fundamental building blocks of your portfolio's stability. There are three exact sizes you've got to know: small, mid, and large. And they each behave totally differently depending on the macroeconomic weather. So, starting with the smallest blocks, small caps. We're talking emerging companies, roughly $250 million to $1 billion in market value. Now, these are your most agile plays, but yeah, they're also the most fragile. Historically, they thrive in one specific environment, and that's early bull markets. Why? Because that is the exact moment when the market's risk appetite is exploding, and those unexpected growth surprises, they get rewarded the absolute most. Stepping up a tier, we hit mid-caps. These are companies valued between $1 billion and $5 billion. They sit right in the middle, offering this really fascinating balance. You get some of that raw, aggressive growth potential, but it's anchored by the sturdiness of a much larger corporation. Finally, we reach the top block, large caps, your unshakable blue chips. These guys offer serious stability and, crucially, dividends. Because of that, they're your go-to during the more conservative phases of the cycle, specifically the early or late bear phases we mapped out in episode 3.1. When you desperately need a financial fortress, this is where you go. So here's the golden rule of thumb. You have absolutely got to match your cap size exposure to the current cycle phase, not just your personal risk tolerance. Like if you're a super aggressive investor by nature, but the macro data says we're in a late bear market, you don't go loading up on fragile small caps just for the thrill of it. You match the macro weather every single time. And that brilliantly illustrates our core insight today. Cap size selection isn't a separate decision from your cycle phase analysis. It is literally the same decision. Picking a company size is really just another way of picking a cycle phase. You just can't separate the two. Think of it like a relay race. Small caps run right alongside those early bull sectors we explored previously, like tech and transportation. They share the exact same fuel because both groups feed entirely on a rising risk appetite in the broader market. When investors are feeling brave, this is exactly where the money flows. Let's actually see this in action with a real-world timeline. Cast your mind back to the market bottom in March 2020. Okay, just 6 months later, early bull risk appetite was completely taking off. And by March 2021, a year later, the Russell 2000, which is your benchmark for small caps, sharply outperformed the large cap blue chips. It was a textbook early bull pattern. But, remember that relay handoff. As economic conditions mature later in that cycle, the sprinters had to pass the baton. Large caps and defensive blue chips took it right back and reasserted their relative strength, leading the market once again as the cycle transitioned. All right, let's do a quick check to make sure this is sticking. You've looked at the data, and you've confirmed we are in a late bear phase. You know you need defensive exposure, so which block do you grab? A small cap growth stock or a large cap dividend blue chip? Take a second to think about it. If you said large cap blue chip, you hit the nail on the head. Late bear markets absolutely demand stability and dividends, which is exactly what blue chips offer. Small caps carry maximum risk, and they belong back in the early bull phase. Putting a small cap in a late bear market is literally like sailing a canoe into a hurricane. Just don't do it. Let's tie this all together into your stock selection checklist. You've seen exactly how these blocks perform across cycle phases with that 2020 to 2021 example. Now you know how to pick a cap size range that matches your cycle phase call. It layers on seamlessly. You choose value or growth, you identify your strong versus weak sectors, and finally, you match your cap size to the cycle phase. So in our next explainer, we're going to put all of these choices through the ultimate magnifying glass using the dual screen method. We'll use fundamentals to figure out exactly what to buy and technicals to tell us exactly when to buy it. Because, as we all know, having the right stock at the wrong time is still a losing trade. So here's the provocative question I'll leave you with. Once you've found the perfect company size in the perfect sector, what are the specific, undeniable data points that give you the absolute confidence to finally pull the trigger? We will dive into that fascinating answer next time.